Welcome back, investors. This week on the Investment Diary, we're diving headfirst into what's shaping up to be the busiest and most impactful earnings week of the entire season. After Microsoft and Meta report earnings on Wednesday, the week is far from over. On Thursday, after market close, is another monumental earnings day, as we have both Apple and Amazon reporting. If you're getting value from this video, please subscribe to the channel. We just passed 50 subscribers. So a huge thank you to everyone who's followed the Investment Diary. Now, let's dive into it. Let's begin with Apple. I once owned a significant amount of Apple stock. In fact, it was one of my largest positions for a long time. I genuinely like Apple. I love their products. However, I reduced Apple early this year due to a couple of concerns. If we look at their revenue over the past 3 years, quarter by quarter on a trailing basis, it looks remarkably flat. The revenue is almost precisely the same. Currently, Apple has flat revenue while trading at a premium valuation. You're looking at a near 30 PE ratio on a forward basis and a free cash flow yield of 2.5% to 3%, all while revenue remains stagnant. When I consider what to watch for with Apple, there are some macro concerns like tariff and supply chain impacts. Personally, I don't find these as interesting as other investors. None of that feels intrinsic to the company. While it might be a short-term concern, I wouldn't sell Apple solely because of tariffs or supply chain issues. They're very adept at navigating those challenges. My bigger concern with Apple is their lack of meaningful AI integration into the iPhone. Apple Intelligence and its integration into the iPhone have been a massive letdown. The rollout and consumer adoption of Apple Intelligence features, including both on-device and cloud-based AI, remain pivotal. The March quarter data did show stronger year-over-year iPhone 16 performance in markets where Apple Intelligence was available. However, even with their current Apple Intelligence, which is boosting sales, I'd argue that the current version of Apple Intelligence is still not that intelligent. They advertised it as being like having ChatGPT built into your phone, transforming your device into an incredible, intuitively understanding personal assistant. But what we got were text summaries that, after using them for some time, I disabled because I didn't truly like them. That's not the Apple Intelligence that was advertised to us. So, I believe they are falling behind in Apple Intelligence, which represents a new growth path for them. While Apple still possesses a massive moat, giving them ample time to figure this out, they haven't yet. The other aspect we always watch for with Apple is that this is now a service-based company. They've outgrown being solely a hardware sales company and are now expanding into Apple TV, Apple Insurance, Apple Care, Apple Music, and various other services. We need to see continued growth in these services because, outside of them, their pure device sales aren't growing significantly. While the services business is still growing at a decent pace, I will note that the pace of services growth is also slowing down. Currently at 12% year-over-year growth compared to previous rates of 17% or 18%. So, even this important revenue stream for Apple is decelerating slightly. Apple remains a high-quality, high-margin company with a wide moat. It's not in any significant trouble. There are no major concerns for Apple. My biggest concern, as a growth investor, is that I prefer investing in companies with strong fundamentals that are growing at a brisk pace, faster than the overall market. Apple is now growing slower than the market. It has transitioned into more of a mature, slow-growing, high-quality company that will generate earnings per share growth and free cash flow per share growth, primarily through share buybacks and financial engineering rather than top-line revenue growth. For this reason, while I don't expect a bad earnings report from Apple, I think they'll do just fine. It's simply not a particularly interesting stock for me today. Finally, we arrive at Amazon, reporting earnings at the same time as Apple, on Thursday after market close. This is going to be a highly anticipated report. I feel like Amazon has truly been demonstrating its strength over the past couple of years. If we zoom out a bit with Amazon, looking beyond just this quarter and into the future, there's a specific reason I'm excited about it. And I'll include Google in this discussion as well. Even though Google has already reported earnings, it will make sense in a minute. When we compare Amazon and Google to other tech leaders, particularly considering the widely discussed investor narratives around companies like Tesla, I believe that Amazon and Google are better positioned in a couple of distinct ways. For example, when I look at Amazon, I view it as the best positioned company in the world today for humanoid robots. I'm talking about robots in human form, powered by AI, that could feasibly accomplish all sorts of different tasks. The reason the humanoid form is so crucial is because our world is built around humans. We're the ones who designed and built it. So, if a robot has the same form factor as us, it can perform all sorts of tasks that humans can, but it can do so for longer hours, at lower pay, and without needing healthcare, vacation, complaining, or going on strike, and so on. The company that could successfully tackle humanoid robots could feasibly be worth an enormous amount. Elon Musk continually talks about how the company that figures out humanoid robots could be worth trillions, or even have trillions of dollars in revenue. not just be worth trillions, but generate trillions in revenue. And while that's true, I again believe that Amazon is better positioned than Tesla for humanoid robots. Tesla often shares a lot of its development progress. For instance, with their humanoid robot, they've shown it making popcorn and serving people. However, it's later revealed that these demonstrations involve people controlling the robot, often through a VR system, meaning it's not truly AI controlled yet. It's basically just Amazon, so far, doesn't advertise its technology in the same way. They don't engage in these types of PR stunts or anything similar that Tesla uses to excite investors. Instead, Amazon is reportedly testing this type of technology silently, behind closed doors. A publication called The Information actually blew the lid on this, when someone within Amazon reported to them that Amazon is preparing to test humanoid robots for delivering packages. Reportedly, Amazon has an entire warehouse where they've set up various tests for a bipedal robot that walks on 2 feet, attempting to pick up a package under 20 pounds and transport it from a truck to a doorstep. They're creating all sorts of obstacles and different interaction scenarios to test how well it can accomplish this task. Because if they can figure that out and scale it, they could feasibly replace around 400,000 delivery drivers in the long term. So, this gives you the idea that Amazon is actively testing and working on this. Tesla isn't the only company trying to develop humanoid robots. We have major tech juggernauts like Amazon also tackling this problem. But Amazon is also uniquely positioned because they have an immense number of employees. Let's look at some figures here. While these numbers fluctuate a bit, Amazon has around 1.56 million employees. If we compare this to Tesla, which has about 125,000 employees that could conceivably be automated with humanoid robots, Amazon not only has the capability to develop humanoid robots, but it would also dramatically benefit its margins if they succeed. They have hundreds of thousands, if not millions, of employees whose physical labor could be replaced, or at least significantly reduced, by humanoid robots. So, Amazon stands to gain far more than most companies in the world by cutting down on all these routine repetitive tasks performed by employees through the development of humanoid robots. We also know that Amazon is not new to robotics. They've been involved in this for a long time, reportedly having over 1 million active robots working in their facilities. While these robots aren't humanoid, they do use artificial intelligence. They are in form factors best suited for their specific purposes, but they're using all sorts of different AI, not just pre-programmed rule sets. They're using actual artificial intelligence to learn and solve problems. So, Amazon has already been utilizing AI-enabled robots for some time. They're simply going to try and bring this to the humanoid form factor. Therefore, I believe that Amazon is a better humanoid robot play than Tesla. Amazon possesses a gigantic logistics network that can become incredibly profitable with just a few percentage points of margin improvement. You have third-party seller services. You have advertising, which they layer upon their first-party sales. You have subscription businesses through things like Amazon Prime Video, where they are the second biggest player in streaming video. And of course, you have Amazon Web Services, the largest cloud hosting platform. Amazon will be just fine, even if they don't win in humanoid robots. Humanoid robots are essentially a call option on the company. It's an additional optionality that investors can look forward to. And even though they are well positioned for it, with ample experience in robotics, their own manufacturing plant for robots where they've produced over 1 million of them, and their ongoing testing of new humanoid robots. Even if all of that doesn't work out, the company is still fine. Now, when we look at Amazon and what to watch for going into this earnings report, we have a WS in generative AI, growth and capacity. Obviously, for all three of these companies, Amazon, Microsoft, or Google, the big question is always cloud. How much is it going to grow? What are its operating margins? We'll be looking at that as a top priority for Amazon. The previous quarter highlighted AWS's robust performance with a 17% year-over-year revenue increase, and their multi-billion-dollar AI businesses are growing at triple-digit rates. They're separating out normal on-premise to cloud transitions from their dedicated AI products. When we look at Amazon and break down the growth rate of Amazon Web Services, this is what it looks like over time. Starting from 2015, it began at around 60%. Obviously, that hypergrowth rate simply isn't sustainable. No cloud company can maintain it for long. So, it ebbed and flowed for a while, but they kept it around 20% to 30% for some time. Back in 2021, it bounced back up to 40%. Then it slowed down dramatically, which caused a lot of concern when it decelerated to 12% in early 2023. Now, with artificial intelligence and increased cloud momentum, it has picked back up from around 12% to about 18%. Obviously, artificial intelligence is playing a significant role in this. They state that any progress on these fronts can directly affect operating margins in unpredictable macroeconomic conditions. So, we want to see efficiencies with their cost structure and the speed of delivery from their fulfillment network. The other factor is the tariff impact and inventory strategy. What I've observed over the past couple of months is that the concerns we once had about tariffs have basically fizzled out to nothing. We know that President Donald Trump monitors the market and tends to respond if the market drops. We also know that he's already made numerous deals. There was just a new one with the EU. And it seems a lot of this is more in line with reasonable expectations. I don't think there will be as much panic around tariffs as there was a couple of months ago. I don't worry about tariffs because they are not an intrinsic part of this company, just as I don't worry about them with Apple. It's not the biggest concern. The next thing we can look at is advertising. Amazon's advertising business grew 19% year over year, last quarter to $13.9 billion in revenue. Advertising is often viewed by investors as this separate business. We have advertising right here in the green, and it's a super fast-growing segment. Let's cross it out here. It grew 19% year over year. We often segment and silo this off as though advertising exists in a vacuum. But in reality, it's an integral part of first-party online sales and third-party seller services. Overall, there's a lot of things to get excited about with Amazon. They are in a very unique position to become a monstrously huge company. Amazon is one of the few that has so much optionality baked into the business model. I can easily see this stock doubling from here. I'll be a little bit patient with Amazon, but I'm very bullish going into this quarter. Now, that's going to wrap up the busiest earnings week of this season. If you got value from this video, please subscribe to the channel. If you agree or disagree with anything I said, let me know in the comments below. And if there's a company you specifically want me to dive into, let me know in the comments section too. I hope to see you in my next diary.